As of this moment, Uranium Royalty Corp is trading at $4.75 per share, surging an incredible $0.48 or 11.24% during today's session. Now, an 11% single-day gain is enough to grab anyone's attention, and the immediate assumption for most people looking at this on their Fidelity mobile app or through a Robinhood widget is simple. Uranium is hot, so all uranium stocks are flying. But that expectation, while not entirely wrong, misses the entire point of what this company is and why this specific surge is far more nuanced. This isn't a company with trucks, drills, and geological survey teams. This is a company of financiers. It's a specialized bank for the nuclear fuel cycle, and understanding that distinction is the key to figuring out if this is a sustainable move or just sector-wide euphoria. The common belief is that to get exposure to the soaring price of uranium, you must buy the miners, the companies that physically pull the stuff out of the ground. This feels direct, it feels tangible. Yet this approach is riddled with operational risks that most investors underestimate. Permitting delays that can last decades, mine floods, equipment failures, labor strikes, and massive front-loaded capital expenditures. The reality is that Uranium Royalty Corp, or URC, offers a completely different proposition. It sidesteps almost all of that direct operational risk. It profits from the uranium bull market without ever having to operate a single mine itself, making it a potentially smarter, more durable way to approach this secular trend in energy. Let's break down today's powerful move. The trading volume accompanying this 11% spike is significantly above its daily average, which tells us there is strong conviction behind these buys. This isn't just passive index buying, this is active capital flowing in. This influx is happening as the entire nuclear energy complex is being reevaluated. We're seeing a global energy deficit, compounded by the immense power demands for data centers for AI, a sector dominated by giants like the ones behind NVIDIA stock. That power has to come from somewhere, and intermittent renewables alone can't provide the 24/7 baseload power required. This has forced governments and utilities worldwide to look at nuclear energy with fresh eyes, signing long-term supply contracts at prices well above what we saw just a few years ago. URC is a direct beneficiary of this sentiment, but its structure insulates it. When a major miner like Cameco reports a production downgrade due to operational issues, their stock takes a direct hit. For URC, which holds a royalty on some of Cameco's key assets like McArthur River and Cigar Lake, the long-term value proposition remains intact, and the supply squeeze actually drives the underlying commodity price higher, boosting the value of URC's other assets. This is the asymmetry that many people miss when they are doing their online investing. They see the headline and buy the sector, but the instruments within that sector have vastly different risk profiles. Many investors using SoFi Invest or other accessible investing sites are gaining exposure to this theme, but the sophistication of URC's model warrants a closer look than just a surface-level price check. So, what does URC actually do? In the simplest terms, it's a financing partner for the uranium industry. It provides cash to mining companies that need funding to explore, develop, or expand their projects. In return, URC receives one of two things: a royalty, which is a percentage of the revenue generated from the mine's production for its entire life, or a stream, which is the right to purchase a certain percentage of the mine's future output at a deeply discounted fixed price. This means as the price of uranium goes up, URC's profit margin on its streams expands dramatically. Furthermore, a significant part of their strategy involves physically acquiring and holding uranium oxide, or U3O8, in licensed storage facilities. This isn't a paper derivative, it's a direct ownership of the physical commodity. As of their latest reports, they hold a substantial inventory of physical uranium, purchased at prices far lower than the current spot market. So when the spot price rips higher, the value of that inventory on their balance sheet increases dollar for dollar. This creates a powerful, multi-pronged approach to profiting from the nuclear thesis, something that a pure-play miner cannot offer. This diversification is the kind of strategy that sophisticated wealth management services like Fidelity Wealth Management or automated systems like Schwab Intelligent Portfolios look for when building commodity allocations. They are looking for exposure to the upside while mitigating some of the idiosyncratic risks of single asset operations. The future outlook for Uranium Royalty Corp is directly tied to the health of the nuclear energy sector, but with its own unique catalysts and risks. The primary catalyst is, of course, a continued structural deficit in the uranium market, where annual demand from reactors outstrips annual primary mine supply. This deficit is currently being filled by secondary supplies and inventories, which are finite. As those dwindle, utilities will be forced to secure long-term contracts at even higher prices, which directly benefits URC's portfolio of royalties and streams. Another major catalyst is project advancement. URC holds key royalties on some of the world's most promising development projects, such as Denison Mine's Wheeler River project in Canada, which is poised to be one of the lowest-cost uranium mines globally. When that project gets the final green light and moves into production, URC's royalty will transform from a line item on a spreadsheet into a significant, recurring cash flow stream for decades. This is patient capital at work, and the market is beginning to price in the probability of these future cash flows. Looking at a platform like Interactive Brokers, which provides deep analytical tools, an investor can model out these future revenue streams and see how sensitive the company's valuation is to both the uranium price and the production timelines of its royalty partners. However, no investment is without risk, and it would be irresponsible to ignore the potential downsides. The most obvious risk is a reversal in the uranium price. If a new large-scale supply source were discovered and brought online quickly, or if the projected demand from new reactors fails to materialize, the uranium price could fall, negatively impacting every aspect of URC's business. Secondly, there is counterparty risk. While URC holds royalties on projects operated by world-class companies, those companies are not immune to financial or operational distress. A major issue at a key partner's mine could delay or reduce the expected cash flow. Finally, there's the risk of dilution. URC's growth model often involves issuing new shares to raise capital for acquiring new royalties, streams, or physical uranium. While this expands their asset base, it can also dilute the ownership stake of existing shareholders if not done accretively. An investor doing some self-investing has to weigh the company's track record of capital allocation against this potential for dilution. Comparing its performance to broad market fidelity ETFs or even a tech-heavy portfolio with Apple stock and Tesla stock shows a different kind of volatility profile, one driven by commodity cycles and industrial policy rather than consumer trends and technology platforms. With the global energy grid under increasing strain, I want you to think about the long-term picture. Comment below what percentage of your portfolio you're allocating to the entire nuclear fuel cycle, from miners to royalty companies. In closing, the initial expectation when seeing URC's 11% gain is to lump it in with every other company in a hot sector. It's an easy narrative. The reality, however, is that URC represents a far more calculated and structurally insulated method for participating in the nuclear energy resurgence. It is not about digging in the dirt. It is about intelligently financing those who do. The company has created a diversified portfolio that gives investors exposure to the upside of the uranium price, exposure to the exploration success of its partners, and exposure to some of the best-in-class, long-life assets in politically stable jurisdictions, all while mitigating the direct and often brutal risks of mining operations. The tension between the simple story of a rising stock and the complex reality of its sophisticated business model is where the real opportunity for understanding lies. This isn't just a bet on a commodity, it's an investment in the financial architecture that underpins the future of nuclear energy. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.